Hey all, welcome to ShareTreck. This is Raj here. As the year comes to an end, I am looking at a set of 5 or 6 high risk factors which I think the market is not paying attention to, and those 5 or 6 high risk factors I think is going to impact this 2025, and therefore I'm getting all out of stocks. I'm already 60% out, and probably on Monday I'll try to sell the remaining and stay in cash for the time being. And I'm going to take each one of these factors and make a separate video on them because I want to expand on each of those. I want your feedback. Please let me know whether I'm deluded or you agree with what I have to say. Today, my topic is about the Bureau of Labor Statistics and how their data could be an Achilles heel for the US economy. Let's get started. Welcome back, friends. The Bureau of Labor Statistics, or BLS, has faced significant budget constraints in recent years. Between 2010 and 2022, the BLS budget declined by approximately 10% in real terms. According to reports from the US Department of Labor, this underlying fund has impacted the Bureau's ability to effectively collect, analyze, and disseminate accurate economic data. Specifically, budget cuts have affected crucial programs such as regional data collection. Reduced funding may limit the ability to gather detailed employment and wage data at the local level, hindering regional economic analysis and policy making. The other area where they have faced cut in real terms is job training programs. Cuts may impact the development and dissemination of valuable resources and training programs for workers, potentially hindering workforce development efforts. These resource limitations have contributed to several challenges. The first one is declining survey rate responses. The response rates for key surveys like the Current Employment Statistics, or CES, have fallen, increasing reliance on statistical imputation methods and potentially compromising data accuracy. Data timeliness and accuracy is another factor. Delayed data releases and increased uncertainty in economic indicators can hinder timely policy responses and complicate economic forecasting. The other symptom that we have seen is significant benchmark revisions. I suspect the 2024 annual benchmark revision, which will probably happen in the first quarter of 2024, I think it's going to happen in January 2024, is expected to reveal substantial discrepancies, potentially signaling past overestimates in employment growth. This highlights the impact of data quality issues on our understanding of the labor market. Frequent data revisions erode trust among policymakers, businesses, and investors who rely on accurate and timely economic data for informed decision making. Volatile employment statistics complicate economic forecasting and planning, increasing uncertainty and potentially hindering investment and economic growth. So if you look at the Federal Reserve, they have two focuses. One focus is on labor, making sure that employment levels are maintained. The second focus is on inflation. If employment becomes too tight, inflation will go up because wages will go up and wage pressure will create inflation spiral. And if employment goes down, then we can tend towards recession because demand might fall. So those are the twin focus of the Federal Reserve. And when the Federal Reserve looks at employment data coming from BLS and all economic statistics coming from BLS, it becomes problematic if BLS is not able to collect 100% actual response and instead uses statistical methods to project and compensate for statistical response not received from participants. Then what is likely to happen is when the actual data is collected at a later date and the reconciliation is done for the whole year, that could be huge discrepancies, huge downward revision that is possible. And right now, when the Fed reduced 25 basis point, they said that they are not much worried about inflation right now. They just wanted to make sure that the employment level is stabilized. And now imagine if in January we get data revision from BLS that says that they had significantly overestimated employment in 2024, then the market is definitely going to fall down. The market is going to be spooked and they will expect more rate cuts to come in. So those kind of situations are possible. However, for a long-term investor, these are not something to worry about because in the long term, equities tend to go up because currency keeps getting devalued. So all the stocks will be worth much more in dollar terms because the currency itself is getting devalued. So from that perspective, there shouldn't be a problem. But the knee-jerk reaction of the market when they hear that the employment was much lower than what they thought it was would be that, oh my God, the future demand is going to go down, and therefore they will start selling. So that drop which comes in is what I am worried about. So if you anticipate the drop and if you are able to keep cash handy, you can then buy at a dip, because I personally think that my strategy would be that when there is profit, I would like to take those profit and wait. Even if I have to wait for 3 to 6 months, I'm okay with that. But I would buy when it's at the bottom, so that I can repeat this process again and again. I think we make money when we buy at the bottom. Everything else happens on autopilot. Then afterwards you don't have to worry. The trickiest part is to buy closer to the bottom. And I think we'll get that opportunity in the first quarter of 2025. I'd like to hear from you guys. What do you think about this? Please let me know. And I'll get back to you with the next video with more factors. Thanks and have a great day. Bye for now.